Welcome to TradeSpoon. My name is Vlad Karpel. I'm CEO and founder of TradeSpoon, and today we're going to have our weekly strategy roundtable discussion where we talk about current market conditions and any questions you might have, and where the opportunities in the market. For those of you who are new, welcome. If this is your first live event, do me a favor, tap in first. Always want to welcome new subscribers. Joseph, Mark. Thank you. For everybody else, welcome back. Really appreciate your time. My background, for those of you who are new, more on the technology side. I was the CTO of several publicly traded companies here in Chicago. I was a consultant and investor in several fintech companies. So I'm very passionate about fintech, very passionate about artificial intelligence, neural networks. We have a team of financial engineers that are constantly building models and looking for opportunities in the market, trends analysis, support, resistance, which sectors can outperform the market, especially with the latest innovations. So that's my background. I also been managing my own money for over 25 years, so pretty proud of that experience. So that's my background. Disclosures are very important. I'm going to go through specific trade ideas, signals, some live positions. So it's very important to understand the risk associated with trading stock or options. Right? I encourage you to visit optionscampion.com so you can understand the risk associated with trading stock or options. I'm not a financial advisor. I'm not registered with FINRA or SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, should not assume that the future trade picks will be profitable. All right, before we get into trading plan, trading psychology, let's talk about current market conditions. We'll continue to make all-time highs, right? The pretty impressive rally, almost, kind of this since October of basically since pandemic, right? Pandemic low. Right, so kind of a straight line, 50% retracement, right? Close to that, and then new highs. And the question is, how much further can the market rally? Right, you can see kind of a same thing from October of 22, from the lows of October 22, almost in a straight shot. I mean, we did have a 10% pullback, and then another leg up. Right, so the question is, this A, 1, 2, 3, when the 1, 2, 3 ends, or when a smaller A, B, C, where does it end, right? And how much further can the market go? We are right at that magic 500 number that everybody was talking about. Everybody expected it, right? We broke through the 480 level. So how much further can the market go, right? And you have two narratives, right? Bulls obviously winning with the soft landing narrative. The Fed already announced that they're going to cut interest rates, right? So it's just a question of time, whether probably not March now, but maybe May or June, right? And that the economy is still very resilient. People have this money, they are working, wages going up, rent is going down, services data showing expansion, GDP, somewhere between 2 and 3% in Q1 projected. So we're in economic growth, right? So soft landing. So that's one narrative, right? And then the market continues going higher, right? That's kind of a scenario number one. What was the move here? Let's do some distances. People like to do distance move. So let's see, measured move. So almost in the straight line, we're 100% return, right? 100%. Then we dropped 27%. And we're up 50%, are we going another 50%, right? So we already went from 346 to 500, 140 points. Are we going to another 140 points in the next couple of years, right? This is a weekly chart, and we're analyzing, right? So that's what a lot of people call it, right? Maybe not this year, but by end of next year, somewhere around 6,000 level, right? Another 100 points, another 20% from this level in the next couple of years. Okay, so that's the soft landing narrative, right? The recession or stagflation narrative basically says, well, nothing has changed, right? It's the same narrative that interest rates are still elevated, right? We still have yield inversion where 2-year is around 4.5, 10-year is at 4.17, right? Interest rate is still elevated, right? 25%, 25 basis points, or even 75 basis points cut this year, or 1% rate cut, where we already kind of have that 100 basis points rate cut. If interest rates stayed at these levels, for another year, then something's going to happen, like NYCB, right? Had liquidity issues. These liquidity issues going to happen as companies have to refinance their debt, right? A lot of the debt is coming due this year and next, and as it's coming due, and you have to refinance, at much higher rate, then there will be liquidity issues, whether it's corporate, WeWork of the world or NYCB of the world, right? So at some point, you will have some kind of a recession. So those are the two narratives that, people are advocating. Obviously, since October of this year, bulls are winning. When we had a pullback, 10% pullback toward the October of last year, then, hard landing narrative was winning. But ultimately, there was always evidence for, both sides. It's just a question which, side you believe, you want to lean into. All right, so again, as an short, medium term, long term trader, you probably do care which way the market is going, right? Day trading maybe not so important, but if you're holding positions overnight for a few weeks, for a few months, for a few quarters, it's important to kind of have a view on the market. So we do have a pretty strong breakout, 480, right? That was back in August. So one scenario is that, 50-day, we're trading basically in some kind of range, right? We're already at 500. Earnings season is kind of winding down. We know, earnings are better than expected for the most part. So maybe we're trading, maybe we can get to 510. At this point, 510 is the next logical, overhead resistance, and 480, right? 50-day moving average, right? So that's scenario number 2, right? Scenario number 1, earnings season is strong. CPI data next week will show that inflation is continuing to subside. GDP is expanding and up and away, right? So that's scenario number 1. We're going above 510, continue to rank higher. Scenario number 2, maybe CPI is higher than expected. Maybe, unemployment data is going to start lower. Maybe NYCB will, have to declare bankruptcy, or something along those lines, right? And then we're trading in 2. Right, kind of the March of last year's scenario. And scenario number 3, maybe it's not just NYCB, maybe there are other banks, right? And then we drop below 470 level. So those are the 3 scenarios, right? I do like to go over. Bob is not here, so I'm allowed to do it. Okay. He doesn't like the dealer flow, but I think it's important to kind of look, we have these tools, right? Basically options data. Positioning is extremely important, right? If you don't analyze any type of positioning, I think it's, you're missing part of the picture, right? So I do think that looking at the futures data, right? People look at the positioning, right? In the futures market in terms of how overbought or oversold institutions are in the futures data. People look at reverse repo, right? How much reserves, how much liquidity is in the banking system, right? So you do want to look at the positioning, right? There's different ways of doing this, different data to analyze. One way to analyze is options data, because we will live in the worlds of, derivatives, right? Structured notes. So it's important data. It's not, you don't see everything, but you see some kind of a view. So you can see that we have February 16 expiration. That's almost is gone, right? Because we have 1 week left. So there's not much left in February 16. So now March 15th is the March expiration, and then April 19th is the second expiration, right? So April for now is less, right? April is less, and mostly people are hedged March. So you can kind of see the spikes, right? This is where the concentration is in terms of the strike prices, right? Even if you're not an option trader, I think it's useful information. So you can see 20,000, I think you have to look, you have to compare it what it was a week ago. Maybe it was 30,000, now it's a 20,000 peak. But you can see there is a lot of overhead there is a lot of concentration at that strike price, 520, right? 505, 510, 515, and 520. What does it mean? That a lot of institutions, a lot of retail investors basically don't think we're going to get between now and basically April, we're not getting very far outside of 510 level, right? That's kind of where people are positioning. 510, 515. So if your expectation that between now and April we're going to go much higher than 520, you need some kind of a positive catalyst, right? Maybe GDP comes out as 4%, I don't know, but you have to have some kind of a black swan positive effect. Maybe Nvidia has earnings that will just blow everybody's mind, right? So something like that, right? So if something like that happens, then you will get above 520. If something like that does not happen, and we're just kind of reaching equilibrium between bulls and bears, where bulls are slightly, higher, have an upper hand advantage, then 510, 515, 520. That is, a pretty large VANA exposure. What is the VANA or gamma, right? You can look at the same strikes and gamma that correspond. What is gamma, right? And VANA or charm. This is all sensitivity, right? How sensitive the delta of options delta to time, to volatility, and to the change in prices, right? For the purpose of the discussion, you don't need to understand Greeks. Like some people get scared. Oh my God, like why are you even covering this? You don't need to think about gamma, VANA, or charm if this is complicated. Right? These are all second derivatives, so it's kind of hard to understand them, right? Unless you were, got an A in calculus or B. But in layman terms, right? It kind of if you simplify, right? If you simplify, you're basically saying these are the strike prices. Right, strike prices is kind of insurance. People are buying and selling insurance at certain levels of S&P. So between dealers and everybody else, a lot of people sell insurance at 520, right? Selling calls at 520, 510, 500. And then the levels that are really well defended is 420, right? Some people still think, we can get to 420. So they're hedging, right? Big hedge funds, big pension funds, they basically say, okay, I don't want to even think about these levels. So you have 420, you have 450, right? And big spike first is about 25,000, right? At 485. So you have big spike at 485, and then the next big spike is at 474, 485. So if I look at the chart, it basically makes sense, right? 475, 480, this is where the 50-day moving average is, and and this is where the line of defense is. All right, so most likely this is going to be a buy zone, right? Where if it does drop to that level, people are so well positioned, institutions, retail are so well positioned that this level will hold, right? Somewhere between 460, 480, I think it just depends on the trigger, whatever the trigger is for the market to pull back. This is pretty strong buy zone, and this is where one can consider, going long. And 510, 520 is again, dealers will have to sell the stock if we reach 510, 520, because there's just a lot of institutions are selling calls, right, at those levels. And if the price does approach 510, 515, details basically delta is increasing of market makers, not incentivized to make money. They have to basically make the markets. If their delta is increasing, the only way to decrease the delta is sell the stock, right, in large quantities, right? This is not Vlad decided to sell, 100 shares of S&P. This is, thousands of contracts being have to be liquidated. So that's the sell zone, right, for the next 2 months. So and that's that's the scenario 1, 2, and 3. So how many of you think we're gonna trade in these zones, right? The scenario 1, we're gonna break through the zone, right? Just because you have some kind of large open interest at 510, 515 strike, that doesn't mean it's gonna hold it, right? So 1, we're breaking up, up, and away. 2, no, we're gonna trade in the zone, right? That's 2. And then 3, below 50-day moving average, somewhere below 200-day moving average, right? Regional banks are under pressure. ARK Innovation is still below 50-day moving average. IWM catching up, but still lagging. So there are still signs of kind of distress. So how many of you say 1? I don't care about contract size. I don't care about, strike price or second derivatives. The animal spirit is alive. ARM went up by 50%. NVIDIA is going to go up by 50%. Pelletier went up by 50%, up, and away. That's 1. 2, basically soft landing, hard landing, still not clear. And then 3 is, signs of recession, basically. All right, 2, Mark, Joseph. Thank you. Andre, BJ, Don, Ed, Joseph, Mark, Michael, Patrick, Peel, Randy. So you guys are a lot more conservative. I did the same webinar on Yellow Town. Everybody said 1. Okay. So, okay, 2. Nobody said 1. Nobody said 3. Wow. Yesterday we had more people said 1. Okay, fine. 2, I agree. 2 is, I agree. Right. Then 2. I think it's going to be just like where portfolio positioning, dealer positioning shows, right? Assuming no black swan event, right? We can't really time or predict black swan event, but it looks like the equilibrium between bulls and bears is somewhere between 50-day moving average, a little bit below, a little bit above, and 500, 510 level. So that's scenario number 2. What does that mean if we're at 500? Well, that means that you probably, if you are long, congratulations, right? You made a lot of money. Maybe it's time to trim your positions. Maybe it's time to sell calls. Maybe instead of stock, buy calls, right? So you have a limited, you still have an upside, but limited downside. But you're decreasing your portfolio delta, right? What does portfolio delta means? It means that you have some long and some short positions, right? If you're in the world of stock, you want to start, removing some of the positions that you were long the market and start adding positions that should do well if the market pulls back, right? Gold should rally, maybe treasury should rally, maybe some of the healthcare stocks, maybe some of the consumer staple stocks will rally or will at least outperform the market on the way down, right? So you change your portfolio composition, right? That is the message if you said 2. Obviously, if you said 1, this is a time to maybe start deploying some of your cash. And if you said 3, then maybe you have more negative portfolio delta instead of neutral portfolio delta. So that's how I would look at this data, right? We still have to reconcile the yield, right? We're approaching CPI data, right? Right now, earnings will not matter, right? We already know all the earnings is better than expected, so that momentum is already factored in the current price level. So now it's all about CPI data. Not everybody knows what the CPI data will look like, right? So, I think there's 3 scenarios to all macroeconomic data, right? If data comes in if CPI is a lot higher than everybody expected, then inflation is back on the table, probably not going to lower interest rates, right? And then means that the market is going to pull back. If core CPI is significantly lower than everybody expected, then it feeds into the narrative of recession, right? Why is CPI dropping so quickly, right? Bears say it's because of recession. Bull says it's because of immaculate disinflation. Everybody have their own opinion. Nobody knows exactly, but market will react. But if it comes in within line, kind of trends in lower, kind of linear, slow move down, right? If you plot CPI data, of course, but it's trending lower, right? Then that's good for the market rallies. But if you have all of a sudden spike up or spike down, right? Well, somebody has to explain these spikes, and that's when I think, and that goes for most of the macroeconomic data. Next week is obviously CPI, retail sales, and PPI, right? That's kind of the major events going into the next week, and then February expiration, right? February expiration, dealers have to close their February. February expires, everybody's closing their February position. They're rolling them into March, April, and then the question is, are they bullish or are they bearish? Okay, so interest rates, right? This is the new dynamic since the start of the year, since the 2024, right? We have basically interest rates are trading in this box between 420 and 380. Obviously, as long as it's trading in the box, that's good, more or less, volatile, but stable, then, market is going to grind higher, right? If we break above this level on CPI, right, or we break significantly below this level, that could be, signs of distress. But as long as we're trading, in this box, then I think this is good for the market. At least it has been good for the market. You still need to reconcile this whole notion that interest rates is going higher and market is continue to going high, right? So people are buying QQQ and they're selling TLT. Kind of, this is what used to happen before, before the inflation concern. But in the past 2 years, it was the opposite. Interest rates going higher, markets are going lower. So we're in a new regime, right? Inflation is not anyone's concern right now, right? Everyone's concerned now that we know that interest rates are going to be lower, right? We don't have to guess that. Then just the question of how fast, the magnitude. But the dynamic is that people are either buying bonds because they're concerned with recession, or they're selling and they're buying bonds, selling equities, or they are buying, selling bonds, buying equity, or buying bonds, selling equity, right? Inversely correlated. The prices are inversely correlated. And that has been since the announcement, since the Powell's announcement, end of December, or middle of December, and then the dollar, right? Also need to reconcile since the beginning of the year. Strong dollar usually is a headwind, right? Markets cannot really go much higher, so dollar needs to pull back. For now, it kind of every week it makes new highs. So it is overbought. It's facing this downtrend. So it needs to pull back, or the equities needs to pull it back. One or the other still have to reconcile. There are signs of other concerns, right? Regional banks, right? They've been weak. Let's look at the weekly chart. So regional banks have been weak. Small caps are actually, pretty neutral, right? I would say neutral. It's not really participating where it makes new highs, but it also was able to defend 50-day moving average. So outside of regional bank, same arc, right? It's been underperforming, but with all the earnings this week and next, since high beta stocks, it looks like it found this support. And I think it's above 50-day moving average or close to 50-day moving average. Yeah, so today it's above 50-day moving average. So you do have basically a little bit broadening of the, or at least stabilization, right? Since the beginning of the year, the number of stocks above 50-day moving average took a big dive below 50-day moving average, below 200, kind of retrace almost half, right? But you still have Microsoft, NVIDIA, Meta, JP Morgan, Caterpillar continue to rally. So markets are still making new highs, but participation has reduced, dramatically. But it looks like for the past, let's see, did we make new lows? Or is it stabilizing at least? And we continue to make new lows, but looks like at least first green candlestick, right, in the past 6 weeks, in terms of how many stocks are above 50-day moving average. All right. So this is all nice and wonderful. How do we help at TradeSpoon? Again, we have weekly webinars, short video. Tuesday we send short video. I think Friday we send, Friday and Saturday you get a blog. And then every Friday we have a weekly strategy roundtable. So you do have a lot of free content on the website. There's a lot of educational, right? Learning center. If you want to learn, there's a lot of recordings. We can learn about technical analysis, fundamentals, stock, options, you name it, through these recordings. We have a YouTube channel. In terms of paid subscription, right? I like to start with Elite Circle, right? So we have different services. We have basically, in my world, in my mind, subscribers are divided into two categories. You have one category where they're disciplined traders, they have trading plan, they don't deviate from their trading plan most of the time, but they usually risk the same amount, position size is always the same, and they just need signals, right? They need valid signals supported by artificial intelligence, supported by someone like Vlad, where they can help with their portfolio construction and rebalancing, right? So for that half of the universe, you have these. I would start with active trader, weekly trade, and monthly trade, right? These are the picks. They're vetted not only by AI, but also by me, right? Because these are the signals that I trade, right? Waste management, right? I think waste management. We had a signal today. You can look at signals every single day. Target, Leonard, all of these stocks, they do look, they look healthy to me. Model picks up. There is a short-term momentum in them. Okay, this is, maybe this is a good buy. All of these are good buys. And then you need to manage them, the entry, the exit. We do provide you guidelines, right? If you day trading or short-term trading, then 1% target gain, 1% stop loss, divide your position into two, right? That's what this strategy means. A means, if you're day trading, look at the pre-market data, right? If the market is down 2%, then you probably want to look at the predicted low. If the market is up 1% or 0.5%, you're probably not going to get predicted low, right? But you might want to concentrate on the yesterday's close, right? Well, in this case, it's kind of both are met, right? But let's say the stock, let's see, target is also down 146. Let's see, Leonard. Right, Leonard, right? So it's at 152.50. It fits strategy A, but entry one it hasn't been triggered yet, right? So then you start asking questions, what do I do? Do I wait for 151? Do I wait for 52? That means you probably don't have a trading plan, right? You don't know exactly how to do short-term trading. Then I would not do this, right? I would not do this. I would basically participate in Elite Circle. This is where you have access to live trading, where all your questions will be answered. You have access to recordings where you can actually see if I trade these signals, how I trade them, right? How often I trade them, when do I open them, when do I close them, when do I roll? There are a lot of questions to manage your positions, right? So that would be Elite Circle. In Elite Circle, I do use Stock Forecast Toolbox, right? This is the neural network. If I want to know spiders, 499, market is overbought. 496, I would potentially buy it. It shows negative momentum, basically saying that the market is overbought. And in the next 10 days, maybe we'll get to 506, and worst case scenario 489. So I think into next Friday, into February expiration, I think this is reasonable to assume that we can reach 490 on the downside and 506 on the upside. Actually corresponds very well with the dealer flow, right? Completely different algorithm, right? This has nothing to do with neural networks or analyzing prices. This just analyzes positioning, right? It just says that in the next 2 weeks, going into February expiration, not even 12/13. So next week in February expiration, most of the concentration is at 504 strike. So probably not going to get too far from 504, 505. On the downside, 492. So this model says, 492, 490, 506. The other model says, I look at my, traditional technical analysis. So I feel comfortable buying it for 90, for 94, and I probably don't want to chase the market at 500, 505, right? So that's how I would interpret this information. In the lead circle, you do get access to well, there's a live trading room, so you can ask questions, right? If you're not sure if the stock hasn't reached this target, do I enter the first 5 minutes, the last 10 minutes? When is the best time to trade? How do I manage this position? Then you have to be in a live trading room. And if I understand, if you don't have time to be in a live trading room, then at least you have to watch the recordings where every time I trade, I will explain why I get in, when I'm going to get out, what are my target gains, what are my stop losses, my rolling position, my closing position. So you have to watch the recordings, right? So you have access to all of that, morning bell, closing bell recordings, and you have a trader log, right? Every day there are trades, so you'll see, I close CCJ position, spread, right? Do I trade only option spreads? No, I trade stocks. So I have HIG position, right? I'm short KRE position that I trimmed. So you'll see combination of both option and stock trading, right? Option, stock, spreads. Depending on your comfort level, you can pick, right? I mean, if you long CCJ and I'm closing CCJ, then maybe at least you need to think about whether you want to add or subtract, or at least you see what I'm doing with the position. Any questions? Mark, IWM, will it hold and move up? So as I said, I'm 2, right? That means that, I don't think Russell 2000 will break this overhead resistance. It's a pretty strong overhead resistance, right? That spans basically over multiple years, right? Multiple years. So the record is 205. If we do break above level, that would probably take away all of the arguments from bears, right? The biggest bear argument is, recession and interest rate sensitive stocks like high yield, high beta, small caps. That's why they're still trading kind of in the bear market from the, peaks of 21, right? They're still, I don't know, what is it? 250, 200, 20% down. They were down 50%, they're still down 20%. So Russell 2000, Russell 3000 are still trading in the bear market, right? Your value stocks, right? The value stocks or technology stocks like your VTV of the world, which is also 3000 value stocks, well, they are trading in the bull market. So my personal opinion, IWM and KRE, because of the interest rate sensitivity and because I don't think we are trading at least right now, I'm still kind of think there is a chance of recession is still pretty high. Some people already say we're in recession, but nobody really knows, right? Some people use kind of forward-looking indicators like leading indicators, beige book. Okay, we're trading in recession, but so that's the level to watch, right? If we do have decisive thrust above this level on IWM, then soft landing, there are no issues, and you're gonna have to stay long until we go below. So I personally do not think it's gonna happen. Let's see what the dealer flow says. Good question. See how people are positioning. So we have February expiration and we have March expiration. So you have a lot of concentration, strike 205, and then the biggest strike is 210, right? So basically, what does it tell you? With positive VANA, right, and a put skew, that basically says in the world of derivatives, which is a very large world, every pension fund, every hedge funds, every wealth management, they're all selling these structured notes, right? There are a lot of ETFs, they do cover calls. So in the world of, derivatives, and as of right now, there's not a lot of momentum beyond 205, 210. That means dealers are forced to sell their stock if the stock is going to approach 205, 210, right? That's how at least I interpret this information. I mean, some people will argue, at least that's how I'm using these tools, right? So from technical analysis, right, that it's a multi-year high, people kind of follow my train of thought. That's, you know, if you have IWM exposure, well, maybe it's time to sell calls, right? Or maybe it's time to buy puts, right? You do have very large concentration. First is in 194, you know, much higher at 185. So 194, 185, right? And we've seen this price action very well defended, right? So unless we have some kind of a, you know, surprise, don't expect that we're going to make new lows, you know, anytime soon, right? Which happen to be, you know, January lows and February lows. So January, February lows are well defended. On the upside, 205, 210 is well defended. So we're trading in a range. We're range bound and we're approaching the upper side of that range. So that's my view on IWM. Joseph, am I still bullish gold and silver? I'm bearish on the market. That means I'm bullish on the gold, right? Some people kind of bullish on the gold, bullish on the market. I don't know how that happens, right? Gold is proxy for fight against inflation and fight against recession. So gold did pull back. It's below 50-day moving average. Silver significantly pulled back. Looks like it's stabilizing, but I still think, you know, we're going to make new highs this year. It's the question of time, and it's a question of a dollar, right? Dollar is a headwind for gold and silver, and it's up, up, and away, right? Bulls have to reconcile that, right? Dollar cannot continue going higher, and equities continue going higher, right? At some point, you know, next earnings season, you know, companies will come out and say, well, dollar went from 100 to 105, right? In Q1, you know, and you know that's negatively impacting our earnings. So, you know, it will be a headwind for their earnings growth for most anyone who has exposure to outside of US, plus commodities, plus. So that's my view on gold and silver, right? I think if you look at gold, I mean, most, even bulls and bears, equity bulls and bears, they're all calling for gold to go higher. I mean, for different reasons, right? For different reasons. But everybody thinks that gold kind of reconciled. It tried in 22. I mean, it's tried it in the past 10 years, right? So last time it tried in 2013, then we tried it in 2020, right? Every time there's some kind of distress, gold continues to rally, right? 2022, 2023, 2024. So at some point, and it's ascending, right? Higher highs and higher lows. So that ascending triangle at some point should break. And if you believe that we're not going to go to zero interest rates, which most people believe that we're not going to see zero, whether it's 3 or 4 is the new norm, we don't know. But you know, since we went from 0 interest rates to, let's call it 3.5, well, you do have the inflation is going to be kind of structural inflation that we're not going to get rid of it by immaculate disinflation, right? That, you know, it will come back, right? People are not lowering their rent prices enough. You know, people are still charging a lot of, you know, inventory issues with the housing. So it's, you know, as long as people are employed and they spend and they travel and you can get a tickets to Florida from Chicago without paying $1,000, well, you know, then, you know, that's not going to miraculously just disappear, right? So that's the gold and silver discussion. Timing is a little bit different, right? That's kind of hard to tell. You know, I still think the pullback is due probably, you know, by end of February, early March. If we don't have that pullback, then I think, you know, earnings are still, you know, positive, GDP is growing. So then, you know, probably we have to wait till summer, right? So if it's not going to happen in the next couple of weeks, you know, market is going to continue going higher. You know, maybe dollar continues going higher or trade sideways, and then this gold breakout maybe has to wait till summer. Any other questions? In terms of themes, right? Obviously, there's different pockets of strength. Some of the stocks that I'm, themes is healthcare, right? Stocks like NVO, Eli Lilly, after the earnings, demand outpacing supply, they're kind of define all the macroeconomic trends, up and away, right? You do have these breakouts, continuation. So that's kind of the patterns you want to look for, right? You want to look for where stocks have been consolidating, right? Like Microsoft or Nvidia, and then they have this big breakout and continue to make new highs, right? You have some kind of consolidation and then breakout. So these are the type of charts you want to follow, right? So, and obviously AI theme is very well alive, right? So Nvidia obviously continues to make new highs. Palantir, another AI stock after the earnings, kind of a vertical move up. I mean, it looks like pulling back today, but it broke out of this multi-month consolidation. So every time you can breaking out of this multi-month consolidation to the upside, then Nucor, right? Some of the steel companies. That's a good theme to follow, right? Steel, government is investing into infrastructure with all the stimulus money. You need steel. So you have company like Nucor, right? Or like Caterpillar, they're breaking out, right? So you have a multi-year consolidation, a multi-month consolidation, and then a breakout after the earnings, flag formation. We know flags formation looks good. Those are the stocks. You have well-defined stop level, right? If it breaks below 50-day moving average, well, something is wrong, right? You have to get out. So those are some of the themes that maybe it's worth considering, right? EWJ, right? Japan, multi-decade high, continues to grind higher. Some of them, do break out. Like I was in CCJ. This doesn't look like a healthy pattern, right? It's still, kind of touching the uptrend. It could reverse, but if it breaks through this uptrend, then you need to get out. But at least you have well-defined stop levels. As long as the uptrend is alive, then you're good. But if you have this double top below 50-day, below the trend, then okay, then time to rotate into a different stock. Joseph's thoughts on CB. This is an insurance company. I did HIG right now. All the insurance companies, they all had great earnings. Right, there's themes, right? So they are, they're interest rate sensitive, but probably one of the best sectors, right? So I think Travelers, CB, HIG, AIG, all the entire sector are still healthy. They're still growing. So as long as the uptrend is preserved, obviously a lot of these stocks are, you have these elevators up, right? At some point, if there's some kind of natural disaster, then they have to pay out higher insurance premiums, then they're going to drop tremendously, right? They just need some kind of a negative trigger. But until that black swan event, for the past couple of years, it just moves in one direction. Obviously overbought, it's going to consolidate and trade sideways till the next earnings season, but I think these are all good stocks. And you have Bitcoin, right? So Bitcoin was able to defend 50-day moving average, and now again retesting the top. Any other questions? Thank you, Joseph. All right. If there are no other questions, then consider joining us Elite Service. It's risk-free. We do give you money back guarantee. Follow our education. We do have YouTube channel and a lot of educational content, and that's all I have for today. Thank you very much. Have a great day, and I'll see you hopefully in the live trading room. Have a great weekend. Thank you.